I have with us today Dell Fujinaka. Dell goes back with our Hawaii office many years. He knows my sister Marcia in particular really well. I met Dell through her probably 20 years ago now, Dell, I would guess.
Yes. Yep.
Yeah, it's been a while. Dell is what we call a cash flow coach, and he's extraordinarily good at it. He has a number of things. He's very prolific. He owns a company called Hoku Legacy Solutions. He also has a radio show called, I think, believe it's called Safe Radio Show. Is that right? Safe Money Radio Show, right, Dell?
Yep.
And he has a book called Safe Money. It's appropriate for this discussion. So Dell, thanks for joining us. Go ahead and take it away.
John, thank you. But I'm excited to share because here's the pivot. The greatest growth comes when you're ready to adapt. And so instead of seeing my face here, I'm going to play a quick clip before I share a little of my testimony and what led to this whole velocity financing, velocity banking. So here goes. Hey, Dell Fujinaka here, Cash Flow Conversations. Just a thought as I was reflecting early in the morning. I often come out here and come out bare feet and think about bare feet, grounding my body. Kind of interesting that our whole body is electromagnetic fields. So it made sense, doing everything to be fit. But I was thinking about the bank and, one perspective of the bank I think about is my pet peeve that money in the savings account, the way we were taught, is something safe, emergency fund, FDIC insured up to $250,000. But that's under the good faith of the federal government. And I was starting to think about even more why people are believing that that's the safe money and what the banks are doing. So walk with me on this. Through the lens of the bank, they not only have you keeping your money there, even though it's technically 100% liquid, but say that $100,000, $98,000 of it can be used as velocity of money for the bank. Other people's money, loaning out, other people paying for interest, that's stable wealth. What if there's a way that was where you could be the bank? And that was one thought. The other thought was, I look at the savings account and it's like dead money. It's like a blood clot in somebody's circulation of their body. Why I say a dead money is because inflation is going at 8%. Your yield that the bank's borrowing from you is at 0.2. You do the math and it's kind of crazy what's going on with our emergency savings account. So I was thinking about this, oftentimes I just come out, play my ukulele. It's like, this is our money at the savings account at the bank. Oh yeah, I know how to play ukulele. Oh yeah, I know what the bank is, savings. But it's not necessarily the best for somebody because this is how the bank sees the ukulele.
Oh, Dell, that has my vote as the very best introduction of any speaker we've had yet. That is awesome.
Well, I just wanted to do that real quick. And okay, so let me pull this up because this will help explain everything. You saw a fun video about velocity of money, and I'm really just quick testimony. I was a financial advisor, had my financial firm for decades. I sold my business in 2018. Ended up diving into the M&A business. Some guys go, wow, Dale, you still doing MMA and punching and kicking? I said, no, it's actually mergers and acquisitions. And with the mergers and acquisitions time frame, I got to be in Japan for every month and got to be rubbing shoulders with quality guys, former presidents of mutual fund companies, private equity guys. And then I even shared office space with a former CEO of a large bank in Hawaii. And the interesting thing happened, I began to see a big just a dichotomy of how people manage money. And even to my side, being very biased in how I gave advice with any money tool. And so this gives really good perspective as I did my transitions and I helped businesses grow and sell and monetize. And then money came over to Hawaii. It gave a whole new paradigm of how I would give advice more, not as a financial advisor. You hear the thing cash flow coach, more like a fiduciary where I get to be alongside all the advisors, whether tax, legal. And that ended up giving me a whole lot more depth in knowledge, more so to simplify stuff. Because if I can simplify the complexities of people's cash flow, it really comes down to this. And the title of this time is how do you velocify your cash flow and your working capital? If you're in position that way, when times a crisis happen in history, we know that when the term blood in the street happens, and if you have that liquidity as well as cash flow, you get to double, triple, and grow your wealth in a way versus just being in a mutual fund. I'm not down on mutual funds, but if you learn more about what it is and the design, you get to separate yourself by applying, if I can say this, bank principles. So it's not what you're investing in. This time, it's really about the tools you have and getting a clear perspective. So, hey, if I'm in front of a bank, I would show this picture. If I'm in front of different businesses, that I was in front of to help them get perspective of money and how they manage their money, their balance sheet, their income statements, and how to bottom line get their growth going, but more so pay attention to what they can save and understand the tools at hand. And so I would show this picture. And let me walk you through this here now, because the majority of us, we understand this cash flow and money action. And this pipe here was created and designed where I gotta just be unbiased. The government doesn't create a solution from a problem that they haven't already created. And so that pipe was created, and more of the majority of us, we understand that that's the term 401k. That's the way my son asked me at 10 years old, what is 401k, Dad? And I said, well, that's qualified plan contributions. And he looked at me kind of, blank, but everybody out of sight, out of mind, it was designed there to control money. But the storyline of when you retire, you'll be at a lower tax bracket. So that's one action. What I want to do is focus on this here. What is velocity financing, of what I call, and others call velocity banking? Well, if you choose to pay your taxes, you basically have more control of your capital. And we're in an unprecedented time in history where the tax brackets are low. And one might say, Dell, what do you mean low? I said, well, let me give you perspective. If you choose to pay your taxes now and not just what I call lock up the money, then you won't have to be subject to whatever the tax brackets are in the future. And this is according to the .gov, irs.gov, their source. And often I'm encouraged, whoever I'm hanging out with, to go to the source. And we take it the average here. Kind of crazy, right, John? You look at the average.
No kidding, Dell. That's pretty visual and pretty impactful.
And people think 50%, the general public. Well, it's already happened in Greece. Japan's highest tax brackets in the 50%. So it's not, possibly this can happen. And you see, if you only have one tool and you think you hit your pinnacle and it's at $1 million and it's in a qualified plan, your 401k, remember now, you're supposed to be in the lower tax bracket. If everybody has to kokua, that's in Hawaiian, work together, and the tax rates go up. It's interesting because the mega wealthy, when the tax rates went up at 94% after a crisis like a World War II, they didn't pay the 94%. They had other tools in their pocket, their financial pocket tool that they used. And so it's really about you understanding that your money positions, it's all about your positioning. And so now here's the other game. as we look at here, we're thinking, and I kind of made that funny video about the savings account. And in a picture, you would see, well, I want to pay cash for stuff, so I'm going to save. And while you're doing that and saving, the bank is leveraging off of 98%, 98% of our savings account. So what happens here is step one, banks look at terms differently. They don't look at what the growth is of each investment they have. They look at how they can create velocity. And if you can catch anything here today, catch this, that if you can mimic the banks and do what banks do, then you have a higher probability that you're going to see success as far as your overall family estate, and I call personal economy. So look at the picture though. They go, wow, you are a gold private banker with me, Dell. And but I have the writing in writing that I can lend out your money. And well, sometimes I might let you borrow it so you can repay at your higher interest. And this action right here is what banks' bottom line foundational way of building their wealth. It's quite interesting. But what if you can be the bank? And I gotta go with this here. You see this shift? We hear different tools to use. It's really about the equity in something like your home, which I'm going to tie it into, equity that you have liquidity though in. And that's a real big key. If you have liquidity in your equity, then you have more power of being the bank. And that's what banks do all day long. So you might say, well, Del, how do you know that banks do this? And I got previewed from the power of association, seeing like 20 billion market cap banks and watching inside the engine, what they do with their working capital. And I got to share one-on-one with people. They begin to see that the documents that I have is inside the bank. And it's not just, you might hear of like bank on yourself or infinite banking or other power of zero terms. And I'm congratulating those guys to get on that journey. But why I call this the legacy banking system is because the way I design the policies, and it has to be through a mutually owned company. You're saying, oh, Dell, you're getting into insurance? Well, if a bank here is public knowledge, the largest bank here in Hawaii has $475 million in cash value life insurance only on their executives, and they collateralize the money. So what I mean by collateralize is they have literally 70% out. So not only do they get to have the multiplying effect of velocity with other people's deposits, but with their tier one capital, they get to do that and bank within the bank. And here's the clear litmus test. If they're doing it, why aren't they teaching it with their financial services? Now that's step one. It has to be structured though, the way that they structure it. And what I found is it's one of three things. Either the insurance company will have their financials solid, they're not going to budge at that. The agent will take all the commission, and it might not be the best product for somebody, or the participant and the policy holder can benefit from it. And if there is a trifecta combo that I've witnessed in the banks, then you might have a really powerful tool in your own personal economy. So that's step one, and if this is in place where you have the majority of the liquidity in whatever you put in, whether you put in 10,000, now it gets even better when you put in 100,000, because banks literally have up to 90% of every contribution they put in. Remember now, don't get caught with the masses thinking, oh gee, I'm worth more dead than alive. They use the policies as a tax shelter, and it's the rule, IRS rule 7702. You can look that up. So here's tool number one. Okay, tool number two, what I love to be alongside clients is creating velocity comes when we can, here in Hawaii, the game of housing, they brag that their property taxes are under 4%. But if you look at it in perspective, the values of the home, people feel proud that, oh, wow, my home is now worth 1.8 million. And John, right? You've been in Hawaii. what a $1.8 million home can be in Arizona or Washington versus Hawaii.
A little different, no doubt, Dell.
It's kind of laughter, but here's the game of the government right here. And just unbiasedly, if they know that, okay, you are putting down your down payment, and that down payment now, you want to crush that mortgage, you pay a little extra of the principal, okay? If your tool with your mortgage is paying it down, and this is not for everybody, but the masses, they feel like if they pay extra towards the principal, the mortgage line will go down, they pay less interest. Can I say this, that within the first 5 to 7 years, the banks have made all their money already, called volume of interest. So they want you to refinance. They want you to play the game of interest rate. But and the power of this is that they have more equity and more power on their balance sheet. And I heard one former president of a bank say the best on their balance sheet is 30-year mortgages. So you have to do your due diligence. If this is the best on their balance sheet, is it the best on your personal economy balance sheet? That's something to think about, okay? But here's what banks do. They don't have, I saw one due diligence of a bank and listening to a large bank in Arkansas, they utilize line of credit. They don't use 30 and 15-year mortgages. Kind of interesting. And they were troubleshooted. We call this term BOLI rescue, and that stands for bank-owned life insurance. Hey, what do you mean? I want to help people with their POLIs then, their personally owned life insurance. If it's exactly designed like how the BOLIs are, I know something is happening. But if you look here, they do the mortgage, and it's all about cash flow now, because now if it's line of credit, and let's say you get 80%, and but I got to say this though, even to get these tools, and you're listening and watching in, they call it underwriting. To even qualify, it's a pretty difficult situation. And if you do have it, you're going to find long term that it's a gem in your overall personal economy. But if you get it, let's say you get 80% liquidity, and you develop again a banking system, and you use all your cash flow to drive down the mortgage interest, the overall mortgage interest. You see the power of this. If this is like a 30-year first lien, you're in the driver's seat with the equity of your home. And I often share this with people in Hawaii. Now you can come against and offset the taxes that Hawaii brags about. They're under 4%. But if it's at 1.8 million, the taxes are getting higher and higher. It's not what you're paying, it's how you're paying for it, whether it's taxes, whether it's any expenses. And I got a fun picture down here, whether your car, whether education, all of this standard of living stuff. If you have these tools in your hand and you create velocity because you know how to use it, it's one thing to set up a banking system. It's another thing to be a really good banker. And you see this picture here. This is just giving the picture that there's in perpetuity. It's exciting when you got infinity going on. You're creating velocity. And that's why I tried to play the ukulele so fast, because if you have these tools in your hand versus having money siloed here, I think you have a better edge of building your wealth. But let me go ahead, John.
Dell, can I ask you a couple questions around this?
Please.
It's kind of at a perfect spot. You've done an extraordinarily good job of kind of tying this together with the philosophy of what's working here. And you mentioned a couple tools, and I want to see if I can bring this down a little bit. First of all, for the people who are not really sure what they understand what the term velocity of money is, can you describe what velocity of money is, Dell?
Yeah, banks call that opportunity costs, as well as the velocity of money describes where you have multiple purposes for the same dollar.
There you go.
So that's the simplest way of putting it up. And that's why the banks love using the bank-owned life insurance and line of credits, because they can actually do that.
Yeah. Okay. And so you're saying that we have the ability to be like a bank and leverage our money and use it for multiple purposes. And you've mentioned a couple tools here, and I don't want to get ahead of the game, but one of them is the insurance, the life insurance, and the other one is how you tap the equity in your home. Are we going to talk about the specific tools that someone can use around that? Is this appropriate for this presentation or a future one, Dell?
How much time you got?
Yeah, good question. I think we probably have another 15 minutes of you for the presentation, and then we'll have some questions after that, I suspect.
Okay, I can hit on one.
Okay, and Dell, we can bring you back. I mean, you were touching on some awesome stuff here. We probably will have to uncover this maybe with a couple future different presentations from you.
Okay, and if you don't mind repetition, I'll show the same picture here.
That'd be just fine. Not a problem.
Fantastic. So yeah, 15 minutes. Let me shift gears here. But one key point here is the dilemma. I can't help but unbiasedly say that there's $32 trillion in the 401k, 457, 403b plans in this government plan, and that never got taxed. And it's quite interesting when you look at the debt and deficit and everything in America is right around $30 trillion, if not more, 32 trillion or two. So I don't know what's going to happen, but my concern is where the tax rates are going to be. And if you only have that one tool, remember now, when you start, the purpose of that money is for another form of income stream, right? And if you only have your 401k, they have the full control to take that marginal tax rate up without alarming everybody. And my concern is that the upper middle class, where they banked on only their 401k, will be at a disadvantage.
Yeah, so I think, Dell, let me articulate what you're saying here, and you tell me if it's exactly what you mean. So guys, what Dell is saying is when you're putting money into your 401k, it's non-taxed at that particular time. But later on, when you're supposed to be in that lower tax bracket, that's the thought, as he mentioned early on in the presentation, and you start withdrawing funds from that 401k to live on, then you're going to get taxed on it. And what happens if they increase the tax bracket? Then you're going to get taxed much more at that time. Is that kind of what you're saying, Dell?
That's a perfect moderation right there. Great moderator. Perfect insight.
All right.
Exactly. Yeah.
So what's the solution to that you might be able to tell us, the first leg of the solution, maybe?
Yeah. I mean, I call it a private reserve strategy. It's a tool, and I'm keying in on, if you have this tool, which is a properly designed, it has to be dividend paying, because there's a whole lot of the aspects of designing the policy, but because of seeing what the banks use the most, I am fully convinced that, hey, if you got that right person who can structure the policy for you, and it needs to be mutually owned, and you're going to hear a lot of rebuttal of that, but we can walk it through. You might be in another state, walk it through, and being unbiased still, the pros and cons of all the life insurance policies out there. But here's the simplest thing: every dollar you put in, if you can see immediately cash value that you can tap into, you're on the right track. Okay. But here's the key term right here. If this policy gives you accessibility and control with uninterrupted compounding, meaning any dollar that's put in there, even if you're collateralizing it, you're getting uninterrupted compounding growth. I'll call it 4% tax-free. Basically, you just 40x one savings. Oh, Dell, but I don't have 100% liquidity. Well, your emergency fund and savings, how often do you access the 100%? You must be pretty much in trouble right now, right? So that's the whole thing of how velocity number one is, if you can 40x your savings account and have liquidity from day one, but have that interest that's growing uninterrupted, even though you tap in on the cash value, you got something good. Okay. So the collateralization is what banks use all day long. They're looking for that distribution yield equivalent. That's a term they use. And when we go here now, and I'll finish off with this here. Okay. There's stuff that can be avoidable with our personal finances. But if you get this paradigm that everything we buy is financed,
and you either pay interest or you give up the ability to earn interest, a lot of times it takes some time to really understand that. And every dollar not saved is consumed by transfers and lifestyle. Then that's why the banks have names on their buildings while others are subject to the banks.
Well
Okay.
put.
Okay. So here's a bigger picture of, all the different financial tools and goals and what we use. And what if it's not what you're paying for, it's how you're paying for it, had velocity of money within it, I think you'd be in a better position. So we must consider, again, banks use this term opportunity costs, but not in just what you pay, it's how you pay for it. Okay. I want to just get to this one here because this one gives a good picture. Everybody buys stuff, right? And you're either a debtor working, trading hours for dollars, you have no savings, you earn no interest, and you pay interest on it. And that's the masses to consume. The savers are a little better because they want to avoid paying interest, but they save and they earn interest and they pay stuff with cash. Sounds really good, but that's not how the banks apply their financial tools. Because here's the wealth creator. From a bank to what I got privy to, mega high net worth guys, they look at doing this here. And this is the efficiency here: compounding interest and collateralized purchases. You won't get this overnight, but if you keep studying, you get to see the terms, and it's more about applying those terms. Now, here's the borrowing side of it. The debtor works to spend. So borrowers, they borrow from a lender at a higher market rate. And the lenders look to lend to create, and you can write this down, the word an arbitrage. When they have that arbitrage or spread, then they're making the money. And people just look at what's close up as long as they can afford it. They got the car of their dreams. They got the stuff that they really want. And that's not what we want to be in. We want to be the bank. So saving, okay, I come across a lot of people who they borrow from themselves, but they reduce the current collateral position and it resets the compounding. And that's just human nature, that if we can't afford it because it's not in the savings, we don't buy it. But there's a different paradigm because that word compounding, if you have a tool, which banks have, then now they borrow from the lender at negotiated rates using own money as collateral and continue to earn uninterrupted compounding. And that's what separates this financial tool and puts you in the driver's seat of every dollar that you're saving and uninterruptedly growing. Now, one can use it just to consume, but it gets even more powerful. John, it's crazy. It's more powerful when I got clients using it to invest, whether it's hard assets, even different changes and paradigm shifts of currency. And that right there, the debtors get stuck. They make payments at higher market risk. The savers make payments to self and get back to where they were by purchasing, giving up the interest their money would have earned. I'm going to finish off with this picture because if you can catch this picture and implement the tool, when you're making payments from a chosen lender and you have the ability to maximize the benefits of your own private reserve account by having uninterrupted compounding, this is a simple picture of my question to you as I end with this is, where do you want to be? Okay, there's changes that need to take place if you're in this position. And you might have the stuff that you think you're happy about or keeping up with the term Joneses on the other side. Then again, you could be this person. And it seems really good. But the banks love these guys because a lot of their savings is what they get to leverage off of. Remember I said the 98% of your savings is used for them to do this. And this is where I encourage everybody to keep studying the banking system, whether it's velocity banking, infinite banking. They all have the good principles. And this is where you want to be. That anytime you're accessing the cash, if you can show proof, and it has to be with mutually owned companies. That's the only way. They have to be privately held because there's too much manipulation with the publicly held companies. Then you know you're on your way to creating wealth the way the banks do. So that I'll pause there. John, I'll pause there.
Yeah, I'm looking for questions in the chat box. I don't see any right now, Dell, but I think I can leverage off your conversation with a few questions for people. So what Dell is talking about is a mutually owned life insurance company, but it's really important to know that it has to be designed properly. Am I correct, Dell? It takes someone who really knows what they're doing to design it in the manner that's needed to get that exponential wealth creation.
That is correct.
Yeah, and Dell's an expert, and that's why he's here. A couple comments on that, Dell, and I know we're going to have you back because you're just opening the door to some really good stuff here. Given that you have a life insurance policy, what you're saying is you can put funds into the life insurance policy, and this is a question, and then once it's there, it can start growing compound-wise, the eighth wonder of the world, right? Start growing in a compound manner, but you can still access those funds and use those for other purposes. Is that what you're saying?
Only in a dividend-paying whole life policy will you get the uninterrupted interest.
There you go.
That's, yeah. So if you're trying to apply, if you're trying to apply banking principles, which I'm assuming people want to know how to do velocity banking or velocity, what I call financing, then this will always be moving. And folks, I'm telling you, like 70% is out with the banks that I've seen of the 400 plus million, and it's going constantly back and forth like this. Okay. But the key is, yes, it grows uninterrupted. So some people might have a legacy where they die. They have the ability to increase the debt benefit if they just replenish the account real quickly and sell an asset. Then the debt benefit just continues to be growing at a tax-free basis.
Yeah, significant. And Dell, it makes sense. The sooner you get started, the better. Is this appropriate for people of all ages, or if you get over a certain age, the cost of the insurance is so expensive it doesn't work? Or comment on that, please.
Yeah, we can go up to, I'm working on one at 78 years old, but that one won't allow me to get everything tax-free. It still be tax efficient and apply banking principles, but the tax-free will only come on the debt benefit side. So the oldest can be roughly almost up to 80. I've seen it work. If you're under 75, we can design it depending on the size of your estate or business. We can design it where it can be following the 7702 ruling that the IRS has and getting every dollar tax-free growing, tax-free if you're living, and tax-free when you die.
Okay, very good. And we just got started on this, but I think what you're also referencing is using your other asset, your home, potentially as an asset where you can tap funds in the right manner and kind of accelerate this process. Is that what we're saying?
Absolutely. Yeah. But I'm very careful with this because if they don't understand the banking principles, then hey, just stay the course with your 30-year mortgage and keep that away, right? But if they do understand, then the power of it is crushing the mortgage down and having liquidity at a time like this where the crisis at hand, and you can get stuff at 30 cents on the dollar. The key is having that liquidity in proportion to the value of your property.
There you go. Yeah. Great for real estate investors, folks. And what Dell is saying here, when you have liquidity available to you, and then the cycle happens, and you can pick up real estate or maybe other assets Dell can talk about for 30 cents on the dollar. That's when you can really start creating some significant wealth with this. That's an impressive discussion to start this thing off, Dell. I can tell we're going to have you back. Would it be, is it conceivable you could do a scenario for us for someone who has or a certain amount to invest, and I think we can get this from our audience. And then you could show them exactly if you put this much in and how long it would take to grow over time. And so people could see some actual numbers around this and how much liquidity they can create over time.
Absolutely, John.
I believe it. We're going to have you back on, Dell. I really like the beginning here. DellFujinaka.com. He's the owner of Hoku Legacy Solutions. And like I said, Dell, is your radio station on once a week over in Hawaii? Is that correct?
Yes.
Okay.
Yeah.
And can we access it either online, or is it can we able to listen to it weekly here in Washington State or on the mainland?
Yeah, I forgot to mention that too. If you put in your name and your email, then for now you can access using the passcode called SAFE, all caps SAFE. Right now it's pretty easy to enter in. And when you enter into SAFE, then you can see here, you just click Safe Money Radio, and you can tune in on, I'm both on the AM and the FM dial, right here on Fridays and on Saturdays.
Well, there you go. Perfect.
Yeah.
Good. And there's Dell Fujinaka right there. That's how you spell it, guys. So you can go to dellfujinaka.com and you can see what Dell's showing you here. All right. Dell, you opened up just a crack, the door to some significant strategy here to create significant wealth. So again, we'll invite you on. Dell's a busy guy, guys. He bounces back and forth between the mainland and Hawaii and possibly Japan for all I know now. And so it's difficult for us to get his schedule coordinated with ours, but we're going to make it happen so he can tell us a little bit more and open this door a little further for you. Dell, any parting thoughts for our audience today?
Just I encourage, to get 2 or 3 sets of eyes, second and third opinions before you make your final decision. Because a lot of times, again, taking just one advice, right? One cannot get the best for them. But if they do their direct due diligence, they have the right people around them, I think you'd be in a higher probability of getting into the right financial tool at the right time in a time like this. So that's the biggest encouragement.
Very good. If you go onto Dell's website, guys, you can also get his book, Safe Money, there. And it'll be sent to you and you can start reading that. And then we're getting back here to talk more about velocity financing and the right tools and the right strategy. It's important. I've seen this before, that you have the right person designing this for you. It can be very efficient or not so efficient. And it works so much better when it's designed properly, so it can be very efficient for you. Dell, thanks for your time today. We really appreciate it. It was great conversation, good presentation. Appreciate that very much.
John, it's been an honor. Always good talking.
Yeah, great to see you again.